In 1 week, $300 billion of SaaS market value vanished. Not an earnings miss. Not a macro shock. An AI product release. For 20 years, enterprise software had a remarkably stable story. Expensive to build. High switching costs. Data locked in proprietary systems. Once you became the system of record, you stayed there. That belief underpinned everything: public market multiples, private equity buyouts, private credit underwriting. Recurring revenue was treated as a proxy for predictability. Contracts were assumed sticky. Cash flows, resilient. Salesforce down 7%. ServiceNow, Adobe, Workday, each down 7%. Intuit fell nearly 11%. The average forward earnings multiple for software companies collapsed from 39 times to about 21. Short sellers made over $20 billion in 2026 betting against legacy SaaS. The IGV software index was already down roughly 30% from its late September peak. This was the week the speed changed. What spooked investors was not that AI generates better features. Software companies have survived feature competition for years. What changed is that modern AI systems can replace large portions of human workflow outright. Research, analysis, drafting, reconciliation, coordination no longer need to live inside a single application. They can be executed autonomously across systems. Feature competition compresses margins. Workflow replacement redirects spend. When workflows move, value moves with them. Chamath posted on X, quote, "The great SaaS meltdown has started and there's no going back. A new AI-oriented workflow is coming. The great SaaS meltdown has started." That captured the mood exactly. Markets do not erase $300 billion unless a core assumption breaks. The assumption that just broke was the durability of legacy SaaS growth. Recurring revenue used to imply predictability because replacing software required human labor, long implementations, organizational pain. AI reduces that friction dramatically. Intelligence becomes portable. Data becomes interpretable. Workflows become replicable. Software increasingly looks like a container. Intelligence becomes the product. Goldman Sachs projects that AI agents will materially expand the overall software market by the end of the decade. But they will capture a disproportionate share of the profit pool. By 2030, more than 60% of software economics could flow through agentic systems rather than legacy SaaS seats. Agents do not merely enhance applications. They become the interface to work itself. The market is growing. But legacy software economics are being diluted. Intelligence, memory, and execution are moving outside static applications into adaptive systems. The public market sell-off was fast. Private markets follow later. Over the last decade, enormous capital flowed into software businesses based on shared assumptions, predictable revenue, low churn, high recovery value. These assumptions justified leverage structures that treated software cash flows as among the safest in the economy. AI does not break these portfolios overnight. It creates a lag. Spend compression appears before churn. Margin erosion shows up before covenant breaches. Economic reality diverges from reported metrics. For debt investors, this is the most uncomfortable scenario. Here is the concrete number. AI agents now autonomously resolve 80% of IT support requests. That reduces seat-based licensing costs by up to 50%. When 10 agents can do the work of 100 sales representatives, you do not need 100 Salesforce seats. Outcome-based pricing, $1 per resolved ticket, aligns vendor incentives with customer results. Companies that adopted outcome models saw 31% higher retention and 21% higher customer satisfaction. The seat is becoming irrelevant. So who survives? Purpose-built, LLM-agnostic AI platforms that deliver portable intelligence and workflow execution. Not feature add-ons. They redefine what the software layer actually does. The edge belongs to systems that own execution rather than interfaces. Revenue becomes less about access and more about impact. Recurrence matters less than replaceability. The $300 billion repricing was not random. It reflected investors' accelerating expectations around workflow substitution risk. Customers do not need to rip out legacy systems overnight for this to matter. They consolidate. They renegotiate. They reduce usage. Cash flow weakens before logos disappear. By the time the data confirms the problem, pricing power is already gone. The income statement lags behind the trend. Software is not disappearing. It is being rewritten. The companies that will win are not the ones with the most seats. They are the ones who understand where intelligence is moving. Chamath was right. The great SaaS meltdown has started. And for investors who can see where the profit pools are shifting, the opportunity is just beginning.